couple of economic indicators out, and I wouldn't mind just putting those to you because to an extent they're showing, I think, what your thesis has been all along. But we got the PCE deflator showing that actually consumer spending is okay, which I mean, that's good, right? I mean, what do we think?
It's really good, especially when the market's been discounting a return to maybe a recession or a crazier event, or even though bond spreads didn't really say anything about a recession, but the equity market was definitely feeling a little bit heavy, and there was a rotation into the things that haven't worked versus the things that have worked. But people can confuse that with a recession coming or something like that. When you see equity weakness and volatility creep up in the equity world, we went from a VIX of volatility index of something like 12 up to 16, and we're probably tamping that down today in terms of volatility. So I think we're feeling like we still like bonds. We're still in a great shape. The PCE numbers today were pretty friendly in terms of spending being pretty healthy. I think we're feeling that that wages have come down a little bit and the pressure is off wage. So I think that's a nice combination for bonds. That's kind of like a Goldilocks environment for bonds.
I mean, it is sort of the renormalization, I guess, to an extent. This is what we've
And
been
coming back, getting away from this heavily dependent economy on Fed and Treasury that we had with the outburst of COVID, and back to a pre-COVID type level where things are working through the system now. You've got things more balanced. Some of the big, a lot of the PPP money is no longer around. You've got things have settled in. We're back to more normal operating environment, which makes risk takers second guess what the government's doing, and really looking at more of the fundamentals of companies, and counting how many bonds big sovereigns are issuing, and how many bonds corporates are issuing, and not worried about the Fed or the Treasury buying back securities, and games like that can happen in those environments. So we're now back to more of a pure let the markets clear type of environment, if that makes sense.
Yeah, which is sort of a more comfortable place to be playing, I guess, with less. You mentioned maybe volatility coming down a little bit. Yields are there, though. We're not going back to zero, I think you say. So what does that mean in terms of owning bonds? Like what can we expect? What should we sort of think? Yep, we love this, and we can expect X.
Yeah, we've been saying this with, we've been on a couple of times with you and others. And I can tell you the market's responding, but bonds are attractive right now. We haven't had these level of yields in Treasury, U.S. Treasuries, since 2006. And so we find that owning duration right now are longer term bonds, not 30 years, but somewhere in that 5 to 10-year part of the curve, very attractive. If you look at benchmarks like the Bloomberg Aggregate Index, which is a 6 duration index, you look at any active manager in the intermediate space, you're getting yields of 5.5 to 6.5%. So you're getting very attractive yields now, much greater than in years past. And you have to go all the way back to 2006. And we don't think there's anything really in the way to kind of disrupt, kind of maybe a higher for longer, or a kind of good starting yield plus a potentially good return, a hidden return. We could have several points of return hidden in the bond market right now if we get a curve steepener and a rally in rates. So that's kind of the setup.
Which implies the yield curve inversion sort of unwinding. I mean, that seems to be what's happening.
And so we've been toggling between 30 to 40 basis points for the last year and a half or so of inversion, and that's probably been one of the longest periods that the U.S. Treasury curve has been inverted, and that's a pretty significant inversion. And now we're in the 20s, so we've gone from 30s, 40s into 20 handle inversion, and it feels like it's about to go. And when the Fed finally, reduces rates, it'll probably be already in, steep, have no inversion in the marketplace. So It feels like it's heading that way today. Like it's not going to happen today, but over the next several weeks, unless we get some crazy, reversal of this, it feels like we're going back with this Goldilocks scenario to something that looks like a more normalized, given more normalized market, maybe a more normalized yield curve.
So I want to ask you a question that's more of an equity question. What does the bond market think, or how could an investor use the bond market ultimately? And what does it mean for the bond market more broadly? That AI is doing what it's doing. I mean, which appears to be reshaping the economy, literally.
Yeah, there's a couple of signals in there where you've got this huge productivity gain embedded in AI spend, and if you believe that AI is going to achieve that productivity, then it's actually pretty good for the bond market because it's inflationary in the long run. It might be kind of near term inflationary with spending all this capex spending and spend by corporations, but over the long haul, if they can turn that into productivity, that means, unfortunately, it means probably a little bit less wages, but wages have come up dramatically. So it could be a nice offset to wage inflation. So those are the very simple knee jerk at the 30,000 foot level where you can kind of use those as decent proxies on why yields might go lower eventually. Maybe not in the very, very near term, but why we are probably headed back towards a more normalized curve, because we have the same issues as the rest of the world, except for Africa, China. Well, China's got the same issue we do, but Africa, India has got huge population growth. We've got population decline almost everywhere else. So China's probably got it the worst. We're probably, right behind. Well, Europe is right behind. We're right there. Canada's right there with US. Although I think Canada's done a nice job getting younger over the last few years with immigration, but we still have that issue that we're looking at, and that could be very inflationary, and that's why this AI trade might be helpful for that inflation as a kind of an inflation buster. If you don't have the employees, but you can do the same amount of work with less employees with AI and tools like that could be very helpful.
Fascinating. Another sort of taking from the equity to go to the bond market question. A lot changes day to day on the U.S. political front. We don't need to go through it. Everyone knows the timeline. But is there a Trump trade in the bond market?
No, we look at we obviously monitor where yields are going, where spreads are going. Spreads are simply, and most people on this call likely know what a spread is. It's just a premium over treasury yields that you'll get for a company to issue debt. So in the 10-year, let's just say the 10-year part of the curve, we're now at a 421 10-year. If the credit is worth 100 basis points, because that's the risk, it's a triple B, it's trades at 100 basis points. That's a 521 or 5.25 yield. The spread piece hasn't changed. It's actually tightened over a couple of basis points. So we're toing and froing on spread by just a couple of basis points, but we're absolutely near the tights, all-time tights in spread. I could argue that we are at the tightest level in spreads, which means that there's not a lot of volatility in the risk markets, because typically if there's a lot of volatility in the risk markets, spreads will gap out significantly, and we're not seeing that in either high yield or in high grade credit spreads. So credit spreads are very solid. They're very sound. There's a lot of yield buyers in the marketplace. They're keeping spreads tighter. They'll buy the yield, which keeps the spread tight, if that makes sense. So we can go through that later if anybody has a question on it. But I think it's just that there's so many fixed income buyers now because it's so attractive relative to history, and the volatility is lower typically in fixed income by about a third versus equities, and so there's a decent amount of demand coming from maybe the equity markets and others who want to extend duration, and others who want to get out of passive and into active fixed income at this moment in time. So
take that one step further, and this is something that you had said. I'm just sort of prompting you for it, but the idea that if you've made sort of massive gains in the equity market of late, it's one of the arguments for putting it into fixed income where you're going to get a yield, but it might protect you a bit from hard to know where all the volatility in the equity market and sort of the Mag 7 is going. It's a really interesting story, and it's had some twists.
Yeah, it's a great story. But if you've got 50 years to invest and you're young, that you may not want to go into any fixed income. But if you want to protect some for the next couple of years and you've got a use for your capital and you're going to need to draw that at some point over the next near term, not bad to get 6% yield or 5.5%, 6% yield and not expose yourself to the higher volatility we're seeing in the equity space. But again, if you had a long time frame, it's hard to argue against long-term returns in equities relative to fixed income on a relative basis.
So let's go into the yield buyers. People are doing for exactly what we're talking about here. Want to get exposure to yield, and that's sort of shrinking spreads.
Yeah. So Pamela, there's huge pockets of money out there. Number one, passive fixed income is massive. That market, that's one of our biggest categories. We've got over 100, I think 100 plus billion in passive fixed income now in Fidelity. We're an active shop, but we open up the capability because we want to make sure our clients are getting what they need. They have to buy bonds. They don't care about what they're paying on spread. They don't care even what they're paying on yield. They just want to know, they have to own what the index owns. So it's kind of a non-relative value buyer in the market. And if you just add up all the passive buying in the market, it's massive. Number two, you've got big pension plans and life insurance companies who need to buy long paper, long bonds, and they care about the yield and immunizing their liabilities. They don't care about what spread they're paying for that corporate. They care about the yield and how they can immunize. So those are three massive columns of buying, and they can typically, if you don't have a blockbuster mega deal like a $10 billion new issuance, if it's say 1 to 4 billion, you can do it all, and with index buyers, and you could announce a spread at 100 at initial price talk, and you can get it done. You can get the deal done 20 basis points tighter than that because nobody's going to drop because you tighten the spread by 20 basis points. Okay. That might sound technical, but hopefully that's easy enough to follow.
No, it is. But and then what happens? You get a rate hike on top of that. We think in September. Do you think in September?
Oh, so you get a reduction in rates, not a rate hike. So if you get that, you'll get total return. So you'll probably make out from a total return perspective because you'll get the immediate 25 bips. We'll probably have tightened a little bit more before that happens. So you're going to you'll have a potential total return from buying that bond. And so you're going to get it. You're going to get instead of getting spread tightening, now it's going to be yield tightening from the treasury component, if that makes sense. Yeah. So one way to make total returns in corporate bonds is to have the spread piece tighten because corporates are doing well and the fundamentals are great. They don't have a lot of leverage. The other part is when the treasury yield component tightens. So you can get a tightening, but if you own treasuries, you're not ever worried about your liquidity on a bond like that. The concern would be owning those corporates, and an index probably doesn't care that much. They care more than the pension or the life insurance company because they'll never sell those bonds. The index might get redeemed, and they'll have to go out and get a bid, but they're not overly worried. We would be more worried about wiping out some of our carry in the portfolio if we owned bonds that widened in spread or yields, the treasury component yield rose to create a negative return. Then we would underperform our peer groups, and then we'd have to explain to clients why we underperform. So that's kind of how the whole system works.
Be less liquid.
Makes sense?
Yeah, no, it does. Absolutely. Tell us then, within all of the different moving parts that you've just described there, what you are buying, and actually probably what you're staying away from. But you've mentioned a couple there. Are there sectors within the corporate story there that are of interest?
So a little bit in corporates we like intermediate and short dated corporates with decent spreads. So triple B rated companies with decent spreads. We like those a lot because they'll carry. Eventually, we'll have a steeper curve. They'll roll down the curve. Right now, they have to roll up the curve because we're inverted, but you still have a spread curve that you'll roll down, and eventually you'll roll down a treasury curve, and that will create total returns every year. So we like those parts. We're avoiding the long end of corporates because you have a lot of those basis points are expensive when you have underperformance, and if the spreads widen in the long end, that can wipe out your carry in those bonds. So we typically, when things feel this tight, we stay away from the long end and we focus more on the front end. But we're underweight corporates in general in high grade space. In places where we can buy high yield, we still like high yield. We still like loans. We've been trimming some of those, but we still like those sectors.
Okay, you like loans still? Yeah. Okay.
We like them, but we've been trimming them because you're going to start losing the SOFR as the front end adjusts lower. You're going to lose that yield, if that makes sense. So
the money market story and front end story is
it's all going to come down. So if you're in money markets, you're not going to get paid for going from 5% to 4%. You're just going to lose yield. Whereas if you own a 5-year bond to a 8-year bond, 10-year bond, 30, those kinds of bonds, you're going to get paid because you'll tighten and create total returns from owning those bonds in those maturities.
So treasuries are of interest, again, with that sort of more intermediate.
We've never had more interest than now in treasuries.
Oh, really?
Because so liquid. So if we have a bump in the night, let's just say we have a slowdown, or right now people can put a massive amount of items on a list of concerns, whether it's Hamas, whether it's Ukraine, Russia, whether it's China, Taiwan, whether you could just keep going. Political issues. We got a lot of things we can be concerned about. If any of that happens, our treasuries will rally like crazy, right? They'll do better than almost anything else in the marketplace. And we can take those very super liquid treasuries and buy risk assets with those. But in the meantime, we're still getting really good yield by owning the treasuries. So we're out yielding the benchmarks by 85 to 100 basis points, even because we still have high yield loans, we still have high yield, we still have a little bit of credit. We like some of the securitized space that has some yield. So we still have better yield than the benchmark. So we can beat the benchmark nicely, but have lots of liquidity ready to go in case of a kind of a bump in the night moment where we need that capital to redeploy into something that's gotten really cheap very quickly because of an event only, not because there's a fundamental problem with that asset.
There's some great questions coming in here, so I'm gonna switch to these in just one second. But I do want to ask you. I mean, everything you've just said there bodes well for the dollar. Well, for a higher dollar, which is good and bad. But is there any reason to think that the dollar won't stay pretty strong?
No, we believe that we think that we're kind of still Fortress North America with our friends up north, and Mexico benefiting from onshoring, and we're benefiting from kind of maybe our entrepreneurial / productivity surges here. We're going to continue to be a good spot to be in, but we like the North America trade, so we don't think there's anything really standing in the way of that.
Okay, really interesting from all this. Okay, so let's put some of these questions to you, Beau. How long do you think the favorable bond market conditions might last? Yeah, take us out a few years.
So there's door number one, we have higher for longer. If we don't get a decent curve steepener, and the steepener means that we've averaged about 100 basis points from 2 years to 10 years since 1990 in the Bloomberg Ag. If we get the 25 basis points and then the 100 on top, it's 120 basis points. That can be a several point total return, and on top of starting at 5.5%, 6%. So if nothing happens, we get 5.5%, 6%, which I think most people would say that's a victory. Then you wouldn't be as worried about your money market going to 3%, 4%. You still have a nice yield advantage over money markets when after the Fed does its thing for the next, looks like a couple of years, we'll probably take 150 basis points out of the front end if if the market is right in terms of Fed funds futures. So you take all that into account, and you're sitting pretty nicely at 6% with hypothetically lower inflation down the road, inflation continuing to come down. So I think that's a victory for most people. Door number two is we get the steepener, and you have a double digit type return, starting yield of 5.5, 6, few points, start 4 to 5 points of total return, and you have your but then you reset at lower yield levels, and that lower yield level could look like more like a 4.5, 4.5. So you'll have to make decisions then on, is that good enough for your portfolio? And then door number three would be bump in the night happens. We take treasuries. We'll still have a negative total return because we have high yield, some corporates, some loans that will all get, will deteriorate in value a little bit, but treasuries will perform to offset some of that. We'll take treasuries and make that into risk assets to get a much bigger return than, maybe middle double digits, like a 14, 15 type percent return, but you'll have to take some pain to get that.
Okay, that's a bit eye-watering, actually, thinking about that. Okay, what about credit? Are you exposed to credit right now?
No, we like credit. It's just that we don't like the value of credit. So we think credit fundamentals are fine. Companies are doing great, but the valuations, if you adjust today's levels in credit, let's just take the credit index today is at 80 basis points spread over treasuries. That 80 basis points, if you adjust it to back at 2006 levels, we're a year longer right now in credit than we were in 06. So call that 10 basis points. That gets you to 70 basis points. And then let's just say our triple B component is 50% today. Back then it was 33% today. So let's call that another 10 basis points. I think I'm being conservative. That gets you to a 60 basis point apples and apples comparison to 80 basis points today. The 80 basis point number today translates into a 60 basis point when you make it an apples and apples. So at 60 basis points, there's hardly any upside. We're not going to zero spread. We're probably not going to 30 spread. So there's a little bit of, maybe there's a tiny bit of upside left, but you mostly are going to be hoping for your coupon clip. And then most likely spread widening event is most likely going to be the next step.
Okay, so that's sort of the bump in the night discussion. I mean, what do you do if there is so-called bump in the night, something goes on, you see a massive gap? You buy that, or is there sort of dry powder?
Treasuries will gap higher. We'll take those gains in treasuries because that'll offset losses in credit. We'll start buying credit wherever it's the cheapest, wherever the most pain is where we'll start buying it. Right. Like in 2020, we couldn't buy high yield.
You're a fixed income investor. That's what you do.
Right, because in 2020, we would have rather have bought high yield, but nobody was selling high yield because the Fed had said they were going to buy high yield. Right. And the Treasury had programs to threaten to buy high yield. So there was no forced sellers of high yield, but companies came to the high grade market and wrote a lot of paper and at very cheap levels. So you have to figure out who the forced seller is in every one of these downtrends. And there's a different forced seller in every market.
Sort of exciting, really. I mean, it's fascinating to watch how you do this. Okay, here's a question coming in. It goes back a little bit to the PCE, but also to what we were discussing in terms of demographic change. So, Beau, do you think the population decline will affect production or consumption-based sectors? And that kind of ties into some of the news out today. What do you think?
Yeah, you know what? It probably impacts consumption more because there's less people around to consume. Maybe smaller households. Maybe you go from 2.5 average to something less because of population decline and fewer people having kids and everything else, and families that are having kids having fewer kids. So my guess is that it would impact that more than I think production probably has a chance, depending on where it's targeted. Obviously, it's got to be away from consumer-based product, because you can't have lower consumption and have higher production in consumer, because it wouldn't align. So let's just say we found a new kind of market for some thingamabob that helps save the CO, has great properties and will, every company in the world needs it. So like AI. So you get something like that, and, production can continue. Maybe we find a cheaper way of producing homes at cheaper levels, and that's we can manufacture homes and ship out pieces. There's lots of ways, but I think there's probably a better chance with robotics, with AI and everything else to keep production level or higher and have consumption go lower. It can be detached.
Okay, it's fascinating. Okay, before I let you go, just a question on timing. In Canada, as you well know, we're well on the road of cuts. We just had our second here. There's the story globally of sort of differential. In terms of investing in bonds, some people will say the window has reopened because you still haven't cut in the US, still hasn't happened yet. And so the rates are up there. You can still lock it in before the cut. What is this window? If you take it to September.
Yeah, it's not much. I mean, you have to believe that, having gone from 40 to 20 handle, that we're losing the window.
Okay.
And I could tell you that over the last 12 months, we've had, there's been a significant amount of flows into fixed income. So, this is mostly driven by underperforming asset managers kind of going into others. So I don't know if this is just, flows out of, it's not out of money markets, but it's definitely a big amount of flow. And a lot of people in fixed income are seeing it. We're again seeing interest out of Asia again. There were stories overnight of Asia buying kind of high yield and loans, and they've been buying high, private credit. So I think there's still a lot of demand for fixed income, even though people have been wary of buying levels here, given that inflation has been so sticky and nasty. It feels like that narrative is probably in the seventh or eighth inning at least.
Oh, I just went to the baseball game last night. Yeah, I like that analogy. We're delighted to have the Jays lost terribly, 12-0. It's brutal.
Oh my gosh.
Like awful to watch. It was
painful.
Embarrassing.
It's so painful.
Oh, anyway, lovely night out. Okay, good to see you. We'll check back in and we'll be watching these interest rates, thinking of you. Thanks, Beau Coash, for joining us today.
Thanks, Pamela.